Hey guys, we're going to talk about how to avoid paying taxes legally with the real estate. There are several ways we can do it. We are not tax professional. We don't have a CPA. We wish we had CPA with us, but we don't have it. But we do file our taxes. I do file my taxes myself. I have, I know a few things here and there, but take this advice with a grain of salt, guys.
And just to add, Venkat, real quick, so tax avoidance is not a problem. What the problem is tax evasion. So there are absolutely two different things. People use tax avoidance. They use the system for the avoidance, which is not illegal. What is illegal is tax evasion, which is separate.
Mhm.
I can talk about those two things on a separate episode, but we're going to focus on how to use the tax avoidance for your benefit.
That's right. Yeah, yeah. But there are so many ways that you can pay no taxes on your rental property. Let's say you have 10 rental properties, and then your income is like, let's say, I don't know, $100,000, right? $100,000 is your all the rental income that you're getting. You probably have to pay like almost $30,000 tax, right, in that income normally. Normally, the typical American like pays 27% tax. So in this case, around $30,000. But you don't need to pay that because if you go through these steps, the first one is like if you have a loan, right? If you bought those properties through a loan, the mortgage, you probably have a interest on that. You probably have a property tax on that. So you can claim property tax. Whatever the property tax you paid on those, it's normally around like maybe for those properties, it would be around, if you have 5 properties, right? It would be around $15,000-$20,000 based on your area. So every location, every county in every state is so different. So you can claim everything, 100% of it, right? 100% of property tax you can claim in the tax return. So that it'll remove some of it, right? And then you can claim all the interest. Like if you pay, like the more interest you pay, it's actually better. So whenever you try to buy a rental property, don't worry about small percentage interest. You're like 0.25%, 0.5% difference. I wouldn't worry too much about 0.5% difference, right? I know a lot of people in the beginning, they always worry about those things. So they even pay like $5,000, $10,000 extra to get that lower, right? Right. So you don't need to do that. The more you pay is better. If you're making more money, actually, it's going to save you more money eventually. So that interest will be taken care. Like it'll be around almost $40,000. You'll be paying interest.
Yeah.
So it's gone like from your tax return. Interest will be taken out, right? And then all your expenses, think about all the expenses that you may incur on that property, right? Probably you listing, MLS listing, if you're listing, or any kind of expenses that even vehicle, right? Your gas expenses, all those things can be climbed. That's another area, right? And then the last one that I want to focus is the depreciation. I know that like most people get confused with this thing. If you said depreciation, how like all the houses are appreciating, right? But we are talking about the building depreciation. Like building gets older. Like think about the building. They have a age like 27 and off, 27 and off year. That is the number that you should remember. If you have a residential property, if you have a commercial property, it's totally different. It's 39 years. So you have to remember 39 years, 27 and a half years for the residential, right? So what, like say for example, you're buying a property for $275,000, right? Let's say you bought a property now, $275,000. Every year you can claim $10,000 on that depreciation because the house gets older, the building gets older. Actually, you have to deduct the. Let's say you bought it for $300,000, but $25,000 is your land value, right? You have to remove the land value. You have to take only the building. Land doesn't depreciate. Only the building depreciates, right? Land is always the same. So you have to remove when you take the depreciation in your tax return for the house depreciation, you can do this for your rental property, not like when you're doing the primary home, unless you're using primary home for the office, for business purposes, you cannot use that. But you can always check with your CPA on that specific. It may vary from your state to state. It might vary. The tax policies might vary. Right. So you have any questions on that, Randy?
Very good. Yeah, I have. So again, going back to your last point and last example, let's recap it. You have, so example was like 200. You buy
Let's say
$275.
$300,000.
Okay,
Yeah.
let's say $300,000 house, and so the land value. Did you say
Let's
20?
say $25,000 land value. Just
Okay, so that
to
okay, so that means
simplify it.
okay, 275,000
Is the
is your
building
building
value.
value, and 27 and a half is we say the life
So
of
you
the.
divide that 275. The building value divided by the 27 and off.
That's 10
Every
grand.
year you can climb that amount.
Okay. So that's
Uh,
okay. So that means 275,000 divided by 27 and a half. That's 10 grand. So you can
mhm.
claim that 10,000 every year in your tax return.
Exactly. Yeah. That's most people don't do that. Yeah. They you can
Okay,
claim.
this is news to me. Like, I learned like in the last episode also we talked about tax avoidance rules. I mean, this sounds like you can really save a lot of money and probably end up even getting some money back from the.
Yeah, this is one thing. There are multiple other there is a depreciation, bonus depreciation. There is an additional one. If
Mhm.
you are changing the windows, like you change the windows, you change some other structures,
Okay.
you can climb that for 5 years, not 27 and a half years. There is an additional bonus depreciation too. Like you should search for bonus depreciation.
Okay.
That is another thing that you can climb. So all these things are there are multiple other things that you can climb for tax purposes.
Yeah.
Because these are the surface level. I didn't go. I'm not a CPA, and we are not advising you on any of this. Based on what we did, we're just giving you guys. So we climb all these things. Once we climbed all these things, I didn't have to pay. Actually, I actually got money back because it went in negative, right? It's a paper loss. Basically, you're not losing those money,
Yeah.
in fact, but it's a paper loss. That is what it is.
So Venkat, what I would suggest, like if anyone is listening to this episode, if you're still with us, sometimes I know that one of my good friends, he fired his accountant because he was not giving his all the deduct all the claims, right? So every every accountant, every tax accountant, it doesn't necessarily. I mean, everyone makes mistakes. Not everyone is aware of the new laws. I mean, they're supposed to, but not everyone is profit. Not everyone is connected to the outside world, up to date with everything. So if you're still using someone else to prepare your taxes, just like myself,
Mm.
make sure that you share these things with them, and that's good for you because at the end of the day, he will work on it. He will also learn something. It's a two-way street. He will also learn, and he will eventually get the money that you richly deserve. Because in the United States, like we pay a lot of tax. The people who pay taxes, they pay a lot of taxes.
27%, right? Yeah.
Yeah, and that's a lot of money, and you deserve at least some part of it if you do it right, if you do it within the legal frame. And this sounds like within that frame, and there's
Yeah.
no harm in asking your CPA or your accountant, tax accountant, about this, because there's a chance that they don't even know about this. So make sure when you go to your tax accountant next year, talk about this depreciation, and also we talked about different things in a different episode, like you buy a vehicle up to 65,000 pounds, something like you mentioned
Yeah,
something.
yeah.
So sorry.
For the vehicle purchase for businesses, also you can climb a lot of money on it.
Yeah,
So we can talk about it in a different
the
episode.
different episode, but
Right.
the point I want to send across is share these things with your accountant, so it's a two-way street. He will learn, he will eventually get the money that you deserve.
Exactly. Yeah, that's a great point, I think. So yeah, even if you're not doing it yourself, it's actually going to be, you can ask a lot of questions to the CPA that you are working with, right? That'll be useful, guys. Even if you save like $10,000 extra, right? That's $10,000 one month, probably your 2 months salary or 1 month salary, right?
Right.
That's a lot of work is
A lot of,
saved.
yeah.
Yeah. Thank you guys for your time, and come back and visit our channel. Bye.